You know that feeling, right? It kind of washes over you. Maybe you're scrolling online or chatting with friends or even just overhearing people. And the market, wow, it's not just going up, it's soaring. Everyone, it seems, is making money talking about these stocks you've never heard of that are doubling, tripling, sometimes like 10 times bigger in just months.
Yeah.
Your neighbor, maybe the one you weren't even sure, had a regular job, just rolls up in a new car thanks to their investments.
Right.
Your college roommate posting vacation pics, paid for, they say, entirely by quick wins in some, hot new sector. There's this energy, this excitement, and you feel this almost overwhelming urge. You have to get involved.
I've got to jump in.
Yes, right now, before the train totally leaves the station and you're just left behind watching everyone else get rich.
That feeling, that powerful, almost primal urge, the pull to join in, when you see other people getting rewards, honestly, it's one of the most potent forces in financial markets. And as we've seen all through history, time and time again, it's led countless investors, straight into danger.
Yeah.
It's really the essence of what we call herding.
Exactly, herding. And that's what we're diving deep into today, this whole phenomenon of herding in investing. This seemingly irresistible urge to follow the crowd, even when, looking back, that crowd was basically marching right towards a cliff edge.
Yeah.
You've shared, quite a stack of sources with us for this deep dive, covering, decades of market history, exploring different investment theories, digging into behavioral finance. It's fascinating stuff.
There really is.
So our mission today is to really unpack what these sources tell us about why following the crowd is so common and, frankly, so dangerous. What lessons from history, from these past manias and bubbles do we absolutely have to learn?
We really do.
And crucially, what are the more disciplined, maybe evidence-based approaches we can use to navigate the markets a bit more wisely, build wealth on something solid rather than just chasing the latest trend?
Absolutely. This deep dive, it's really all about trying to arm you, the listener, with the insights from all this material to help you recognize the signs of herding when it starts, understand the alternatives.
Right.
So you can make more informed decisions, hopefully free from that infectious madness of the crowd, as it's been called.
Okay, let's get right into it then. Maybe start with a really fundamental question. How do we even think about what an investment is worth? Because how you answer that can kind of set you up to either chase the herd or, walk a completely different path.
That's a great starting point.
One perspective, and it's detailed in our sources, is this idea of the castle in the air theory of valuation. Forget just for a second digging into a company's factories, its sales figures, profits, dividends, all that stuff.
Okay.
According to this theory, an asset's value isn't really based on its intrinsic worth, it's tangible fundamentals. Instead, it's all about anticipating what the collective mind of the market, the crowd, will think that asset is worth down the line.
Right. So what price will they be willing to pay based on that shared sort of evolving psychology?
Exactly. It's about predicting the predictors.
Which is such a stark contrast to the more traditional firm foundation theory, isn't it? The theory anchors value in things you can actually measure, like assets, earnings, dividends, tangible stuff.
Totally different.
The castle in the air approach, it's built on something much less solid, much more ethereal, shared belief, anticipation, and it absolutely thrives on stories.
Stories, okay. How so?
Well, as one of our sources points out, there's this idea, we call it Rule 3 in this kind of market environment, that to build these speculative castles, it really helps to buy stocks that have compelling stories attached. Narratives about future growth, amazing technological breakthroughs, total market dominance, stories that are so exciting, investors can easily use them as the bricks and mortar for their imaginary castles of future wealth and soaring prices.
And this sounds exactly where herding slots right in.
Precisely.
Because herding isn't about doing your own homework and deciding, hey, this thing is undervalued. It's defined really clearly in our sources as investors buying or selling assets simply because other investors are doing the same thing.
That's the core of it. No independent analysis needed. Just follow the leader.
You see everyone else running towards that shiny castle in the air with its amazing story, and you just feel that powerful pull to run with them without stopping to ask, is the ground underneath this castle actually solid? Or is it quicksand?
And the psychological drivers behind this are incredibly powerful. They're really well documented in behavioral finance. Maybe the most direct explanation comes from the economic historian Charles Kindleberger, who's quoted in our source saying, "There is nothing so disturbing to one's well-being and judgment as to see a friend get rich."
Wow, that hits home, doesn't it?
It really does. When you see people and people just like you making money, hitting it big by buying into some trend, it kind of bypasses your logical brain, doesn't it? It hits you on a deep emotional level.
Yeah, definitely.
That social proof, that fear of missing out, FOMO, as everyone calls it now, it creates this almost irresistible urge to just join the rush, mimic their behavior because, hey, it looks like it's working for them.
It's like your brain just short circuits and says, they're doing it, they're winning, so I should too. And Robert Schiller's work, which is also mentioned, shows how this can create these positive feedback loops that just inflate bubbles, right?
Exactly. Those loops are key. Maybe some initial price increases happen, perhaps based on a tiny bit of good news or maybe just random chance, honestly. But it catches people's attention. Right. They see the gains, they jump in. Their buying pushes prices even higher. This next price increase attracts more attention, drawing in more people.
Which pushes prices even higher still.
Precisely. It reinforces the belief that prices can only go up, and it just fuels the mania further and further.
And underneath all that excitement, there's often something a bit more cynical going on, isn't there? This greater fool theory.
Ah, yes, the greater fool theory. It's often the unspoken belief lurking beneath the surface. It's the idea that you can buy an asset that, deep down is probably overpriced, maybe even ridiculously so, because you're confident, or maybe just hopeful, that you'll be able to find someone even more foolish than you, a greater fool, to buy it from you at an even higher price down the road.
So it's not really investing at all. It's like a game of hot potato with money.
Exactly.
Yeah.
A speculative game, just hoping you can pass it on before the music stops and you're left holding the bag.
And our behavioral biases, the sources highlight these too, they just play right into this whole dynamic, like the representative heuristic.
Yes, that's a big one. It's a mental shortcut we all use. We make judgments based on how typical or representative something seems of a larger category or outcome, rather than looking at the actual probabilities or the cold, hard facts.
So how does that apply here?
Well, if a stock comes along with a story that sounds like a typical success story in whatever the hot news sector is, maybe it's AI now, or crypto a while back, or green energy.
Right.
Our brains are kind of wired to latch onto that story because it seems representative of winning. We might overweight the compelling narrative, the great story, and underweight the boring stuff, like the lack of profits, the sky-high valuation, the actual competitive risks.
Because the story just feels like a winner.
Exactly. It fits the pattern we expect for success.
And another one mentioned is recency bias. That sounds pretty straightforward.
It is, and it's another major culprit in fueling herding. We tend to give way too much weight and importance to the most recent information or events.
Okay.
So if stock prices have been climbing like crazy, really consistently, say, over the last 6 months, that recent surge becomes the dominant thing in our minds.
Right. You forget what happened before that.
Precisely. We react really strongly to that recent memorable performance. We might start projecting that performance indefinitely into the future, thinking this is the new normal, and then rush into an overheated market. We're influenced much more by that recent spike than by, say, long-term historical valuations or the fundamental reality of the business.
It's just so easy to see how all these psychological forces kind of gang up on us, making following the crowd so tempting.
It really is.
And the history of financial markets. Well, it's basically just a long, often really painful record of what happens when this herding behavior completely takes over. Our sources walk us through some pretty incredible cautionary tales.
Oh, absolutely. And we almost have to start with one of the earliest and maybe the strangest examples, tulip mania, 17th century Holland.
I get the tulips.
Imagine this, prices for tulip bulbs, especially the ones infected with this mosaic virus that caused these beautiful but totally unpredictable stripes, they reached just astronomical levels.
How high are we talking?
Well, initially, merchants were maybe trying to guess fashion tastes in flowers, but it quickly got out of hand. People started viewing the expensive bulbs themselves, not just the flowers they'd produce, as smart investments.
So the bulb itself was the asset.
Exactly. Prices just soared, driven purely by the expectation that someone else would pay even more later on. It was a total castle-in-the-air mania built on, essentially, highly perishable flowers. At the absolute peak, some single bulbs were reportedly selling for more than a house.
A single flower bulb, worth more than a house. It just sounds utterly insane today.
It does, but the underlying psychology. chasing something purely because its price is going up and you expect it to keep going up, that's identical across centuries.
Yeah. Okay, so fast forward a bit. 18th century, the South Sea Bubble in Britain, another famous one.
Infamous, really. The South Sea Company, on paper, was formed to trade with South America. But its real hidden purpose was more about taking over government debt. It put up this really impressive front. The sources mention its fancy rented headquarters, even the director's uncomfortable chairs, apparently.
Yeah, okay.
But its actual business operations. Failing miserably, like wool just rotting away in a harbor in Cartagena because they couldn't sell it.
But the stock price didn't reflect that reality.
Not at all. Fueled by public frenzy, a lot of insider dealing, blatant manipulation, the company's stock price just exploded upwards. Directors like John Blunt apparently embodied the duplicity. He was described as holding a prayer book in his right hand and a prospectus in his left, never letting his right hand know what his left hand was doing.
Oh, wow. That says it all.
The stock soared purely on hype and hope, drawing in absolutely masses of people, from nobles to commoners. And then it collapsed abruptly when the financial reality and the manipulation finally got exposed.
And wasn't Sir Isaac Newton caught up in this one?
He was, the great scientist himself. He apparently made a profit early on, got out, but then caught up in the mania, he jumped back in near the peak and lost a fortune. That's when he famously declared he could calculate the motions of heavenly bodies, but not the madness of people.
A hard lesson, even for a genius.
Indeed.
Right.
And the sources even show this image, an old cartoon of something called Puckle's machine. It was designed to fire different shaped bullets at different targets. And the caption specifically targets the crowd of fools at home that have shares therein. It just shows that recognizing and even satirizing the sheer folly of crowd behavior in financial markets, well, it's a really old idea.
And something similar happened in France around the same time?
Yes, the Mississippi Company stock bubble, driven up by excessive printing of paper currency. Same pattern, different country.
Okay, moving into the 20th century, the 1928-29 peak and the big crash that followed, were there specific herding mechanisms at play there too?
Oh, absolutely. Sophisticated ones for the time. Notably, these things called pool operations.
Pool operations, what were they?
Basically, groups of wealthy operators, insiders, would secretly band together and buy up large blocks of a particular stock. Then they'd work with tip sheet writers, kind of the predecessors to modern financial influencers, maybe in carefully managed company news releases, to create a huge buzz around the stock.
So they were deliberately pumping up the price.
Exactly. Coordinated buying and positive publicity. Then, as the general public, fueled by all that excitement and critically the rising price itself, started piling in, buying in large volume, the pool members would discreetly pull the plug. They'd start selling off their accumulated shares at those inflated prices to the eager incoming crowd.
Making huge profits while the public got stuck holding the bag when it crashed.
Precisely. It's a textbook example of how organized groups could actually exploit the herding instinct for their own gain, leaving ordinary investors devastated when the manipulation stopped and reality inevitably set in.
Okay, so that's manipulation driving the herd. What about the 1970s and the Nifty 50? That sounds different. These were big, solid companies, right?
They were. After the sort of go-go speculative excesses of the late 1960s, the market seemed to pivot. It started favoring seemingly sound blue-chip companies, the established giants like IBM, Xerox, Kodak, McDonald's, Polaroid. Household names.
So what was the problem?
These stocks were hailed as one-decision stocks. The idea was you just buy them, put them away, and hold them forever. They were seen as a kind of security blanket, especially for institutional investors who were feeling nervous.
Sounds safe. Too safe.
The problem wasn't the companies themselves. Many were genuinely great businesses. The problem, again, was the price people were willing to pay.
Valuations got out of whack.
Completely. Institutions, the supposedly sophisticated investors who preached fundamental analysis, started ignoring extremely high valuations. We're talking price to earnings, multiples of 80, 90, even over 100 times earnings for these mature companies.
How did they justify that?
They rationalized it. They argued it was acceptable to pay a temporarily high price because these were proven growers. The belief was their future earnings growth would be so strong and so consistent, it would eventually justify even those nosebleed valuations.
A belief that didn't pan out, I take it.
Not even close. As one source dryly observes, this whole episode proved that stupidity well packaged can sound like wisdom. That blind faith in perpetual rapid growth, regardless of the starting price, proved incredibly costly when, inevitably, those companies' growth rates moderated and their stock prices just plummeted.
Another bubble, just dressed up differently. Okay, let's jump to the late 1980s, the Japanese stock market bubble. That one was legendary.
Astonishing is the word. Fueled by a booming economy, super loose monetary policy, and maybe a sense of national invincibility, Japanese stock prices rose. Wait for it.
Okay.
100-fold between 1955 and 1990.
100 times. That's hard to even comprehend.
It really is. At its peak, the total market value of all Japanese equities was significantly larger, about 1.5 times larger than the value of all U.S. equities combined.
Wow. And the valuation.
Cruelly extreme. Off the charts. Average price-to-earnings ratios were over 60. Stocks were trading at 5 times their book value. Dividend yields were practically non-existent because prices were so high, like 200 times earnings in some cases.
And again, people found ways to explain this away.
Of course. Arguments were made about, differences in Japanese accounting standards, or that ultra-low interest rates in Japan somehow justify these higher valuations permanently, or that the appreciated value of corporate land holdings boosted the underlying asset values.
Excuses, basically.
Pretty much. You had companies like NTT Corporation, the telecom giant, reaching market capitalizations that exceeded several major U.S. companies put together. It was a massive mania driven by national pride, easy credit, a relentless upward price trend. It just shows how cultural and economic factors can also pour fuel on the herding fire, leading to these extreme valuations. And of course, it was followed by a very prolonged and painful crash, the lost decades.
Okay, now for maybe the most recent, and for many of us, the most familiar example of herding driven by castles in the air and just powerful narrative, the internet bubble, late 90s, early 2000s.
Oh yeah, the dot-com bubble, a true classic. An unreasoning herd mentality, as the sources call it, just took hold. It spread like wildfire, mostly through word of mouth, friends telling friends, colleagues, swapping hot stock tips around the water cooler.
I remember that. It was everywhere.
The NASDAQ index, which was heavily weighted with all these new tech and internet stocks, more than tripled in just over a year. Valuations soared to levels completely disconnected from any sense of reality.
Companies with no profits, sometimes no revenue even.
Exactly. Trading at insane price-to-sales ratios, if they even had sales. And the power of the narrative, the story, was so incredibly strong that some companies literally just added .com or .net to their existing corporate names, even if it had nothing to do with the internet, just to seem relevant and shiny, hoping to attract investor attention.
Like putting lipstick on a pig, but it worked for a while. We saw echoes of that later, didn't we? Like that Long Island iced tea company rebranding as Long Blockchain Corp.
Precisely. Same tactic, different bubble.
Yeah.
History doesn't repeat, but it rhymes, right?
It certainly seems to. The sources give a really stark cautionary tale from the dot-com era. Boo.com.
Boo.com, yes. An online fashion retailer. They burned through an astonishing $135 million in venture capital in just 2 years before going spectacularly bankrupt.
$135 million. How?
Well, the co-founder infamously tried to defend their extravagant spending by saying she only flew Concorde 3 times and they were all special offers.
Oh, wow. That just highlights the complete detachment from financial reality that can happen during these manias, doesn't it?
Absolutely. And the human cost is real, too. The source recounts a friend who bought Boo.com shares, near the peak, just totally swept up in the excitement, and they lost their entire investment.
That's
Vanished.
devastating.
It connects right back to loss aversion, but in reverse initially. The fear of missing out on those huge potential gains pushes people into taking these incredibly risky bets, only to suffer massive real losses when the bubble bursts. Eventually, you just run out of greater fools to sell to.
Okay, moving forward again. Mid-2000s. We get the U.S. housing bubble. This one felt different, maybe even bigger in its impact on ordinary people.
Definitely broader, yeah. It had a much more devastating impact on average Americans' wealth compared to many stock market swings, because for most people, their house is their biggest asset.
Right.
This bubble was fueled, initially, by easy credit, low interest rates, and this widespread belief that housing prices could only ever go up. But it was massively amplified by a really fundamental shift in the banking system.
What was that shift?
Banks moved away from the traditional originate and hold model, where they made a mortgage and kept it on their books, bearing the risk, to an originate and distribute model.
Hmm.
This meant mortgages were originated, then quickly packaged together into complex securities, mortgage-backed securities, or MBS. These were then sold off to investors all around the world.
So the banks didn't hold the risk anymore.
Much less of it, seemingly. And then it got even more complex. These MBS were sliced and diced into even more opaque instruments called collateralized debt obligations, or CDOs, creating second, third, even fourth-order derivatives based on the original mortgages.
Sounds complicated and risky.
Extremely. And the whole system was supposedly made safe by things like credit default swaps, basically insurance policies on these bonds, famously issued by companies like AIG, but often without anywhere near the necessary financial reserves to actually pay out if things went bad.
So it created this illusion of safety, but the risk was just hidden.
Exactly. It created a system where risk was seemingly transferred and diffused, but actually just became more opaque, more interconnected, and ultimately systemic.
The sources use a really vivid, if kind of dark, anecdote to illustrate this hidden risk. The woman who survives a heart attack.
Yes. The woman who survives a serious heart attack, gets cosmetic surgery, feels fantastic, looks great, leaves the hospital, only to be immediately hit and killed by an ambulance backing up.
It's a powerful metaphor, isn't it?
It is. Almost absurd. But it captures how apparent safety and recovery surviving the heart attack, looking great after surgery, can mask these unexpected fatal risks lurking just outside the door, like the ambulance. The financial system in the mid-2000s felt safe, innovative, sophisticated. But it was hiding these immense, unforeseen dangers that proved fatal to its stability and, tragically, to many people's finances.
And these bubbles aren't just limited to stocks or houses, are they? Bitcoin, cryptocurrencies, they've shown similar patterns.
Absolutely. While representing genuinely new technology, Bitcoin and other cryptocurrencies have definitely exhibited classic speculative bubble characteristics at various points. The sources describe those dramatic, incredibly rapid price increases, from pennies to tens of thousands of dollars per coin, followed by massive volatility, huge crashes, 50% swings in days sometimes.
And people compared it to.
Comparisons were drawn directly to the historical inflation rates seen way back in tulip mania. And again, you saw that same phenomenon. Obscure little microcap companies suddenly changing their names to include blockchain or crypto to capitalize on the mania.
Like Long Island iced tea becoming Long Blockchain Core again.
There it is again.
Ugh.
It just shows the same psychological game keeps getting played, just applied to whatever the hot new asset class of the moment happens to be.
Okay, so the evidence is just overwhelming, isn't it? Hurting, driven by these powerful ancient psychological forces, amplified by modern tech and finance. It has repeatedly led investors into these speculative manias and crashes right throughout history.
Undeniably.
But surely there must be conventional wisdom, methods like, say, technical analysis or relying on expert fundamental analysis. Surely those can provide a safe harbor, a way to navigate these dangerous waters without just following the herd.
Well, that's certainly the promise often made, isn't it? But our sources offer some pretty significant critiques of these approaches, too, especially when you view them through the lens of avoiding herding behavior.
Okay, let's take technical analysis first. Charting. What's the issue there?
So chartists, or technical analysts, they spend their time poring over historical price charts, looking for recognizable patterns. Head and shoulders, tops, double bottoms, moving average crossovers, things like that.
Right. Trying to predict the future from the past patterns.
Exactly. They fundamentally believe, as the sources state, that the market is maybe 90% psychological and only 10% logical. So they're trying to predict future price movements by essentially predicting how the crowd will react, based on how it seems to have reacted in the past according to these chart patterns.
But the sources say relying solely on charting is problematic. Why?
Several key issues get highlighted. First, chartists, by definition, tend to buy after a price trend is already well established, and they tend to sell after it's already begun to reverse.
So they're always reacting, never anticipating.
Pretty much. They're always looking at past data, which means they often miss the sharp turning points, or they end up buying near the peak of an already established trend just as it's running out of steam.
Okay, what else?
Second, the technique itself can be inherently self-defeating. Think about it. As more and more people become aware of and start using the same charting patterns or signals.
They stop working.
Exactly. Or they work differently. Traders start trying to anticipate the signal before it officially appears on the chart, trying to front-run the chartists. This renders the standard signal less effective, or sometimes it even becomes a trap, a false signal.
It's like trying to win a race by perfectly following the footprints of the person ahead of you. You're guaranteed to always be at least one step behind.
That's a great analogy. And perhaps the most fundamental critique, rooted in academic finance, is the concept of the random walk, which our sources discussed quite a bit.
The random walk. What does that mean for stock prices?
Well, decades of academic research looking at vast amounts of stock price data strongly suggests that stock price changes often behave like a random walk. What that means, essentially, is that today's price change is largely independent of yesterday's price change, or last week's or last month's.
So past price movements don't reliably predict future price movements.
Generally, no. The persistent patterns that chartists hunt for, streaks of up days or down days or specific chart formations, these things appear to occur no more often in actual stock market data than you would expect from pure random chance.
Like flipping a coin.
Exactly like flipping a coin.
Yeah.
The sources use the coin flip chart example precisely to illustrate this statistical illusion. If you just plot a sequence of random coin flips, heads is up, tails is down, the resulting chart can look uncannily like a real stock price chart, complete with apparent trends, support levels, resistance levels, all the things chartists look for.
But it's just random noise.
Exactly. Our brains are hardwired to see patterns even in randomness. It's similar to the hot hand fallacy in basketball. Fans and even players often believe a player who's just made several shots in a row is on fire and somehow more likely to make the next shot. But rigorous statistical analysis usually shows that successive shots are largely independent events. The previous makes don't really predict the next outcome any better than chance.
So trying to predict the market's next big move by analyzing old price patterns on a chart, or relying on complicated technical systems like moving averages, or even old market sayings like sell in May and go away.
Which, by the way, historical data generally debunks anyway.
Right. So all of that is essentially trying to find predictable patterns in process that is, to a large extent, random.
That's the core argument against pure technical analysis, yes. It's not seen as a reliable way to navigate the market long term, and critically, it can still lead you to chase trends simply because the chart looks good, but only after the big run-up has already happened. You're still reacting to the herd's recent past behavior.
Okay, so charting looks like it might be chasing phantoms. What about fundamental analysis? That seems much more grounded, right? Analyzing companies' actual business, its assets, earnings, dividends, the firm foundation stuff. Fundamentalists believe the market is, 90% logical?
That certainly sounds more logical, doesn't it? And it's definitely a more solid starting point than just trying to anticipate crowd psychology alone. But fundamental analysis, as practiced, also has some significant limitations and potential pitfalls, especially if you're trying to use it to time the market or relying heavily on other people's analysis, as the sources explain.
Okay, what are the main pitfalls there?
Well, one major issue is that fundamental analysis relies heavily on forecasting. You have to predict the future. How much will earnings grow next year, the year after, for the next decade? How sustainable are the current profit margins? What will future dividends be?
And predicting the future is hard.
Notoriously difficult, yes, and prone to significant error, especially the further out you try to predict. So that firm foundation isn't just built on today's concrete facts, it's also built on tomorrow's uncertain, sometimes shaky predictions.
And I suppose that foundation can also be deliberately messed with, obscured, manipulated.
Absolutely. Accounting manipulation is a huge challenge for fundamental investors. Our sources provide some pretty vivid examples from past scandals. Think back to Enron and Quest Communications during the dot-com boom.
Right. What did they do?
They were essentially swapping capacity on their fiber optic networks with each other at inflated values, purely so they could book the transactions as revenue and make their top-line growth look amazing.
Even though no real new business was generated.
Exactly. Or think about Enron using all those complex off-balance sheet partnerships, the special purpose entities, to hide massive amounts of debt and even make loans look like operating profits. These weren't just slightly aggressive accounting choices. They were deliberate, elaborate efforts to mislead investors about the true financial health and profitability of the company.
And what's really shocking looking back is how many Wall Street analysts, the people who were supposed to be doing the deep fundamental analysis for investors, seem to either completely miss this stuff or, worse, maybe actively went along with it.
Well, that brings us squarely to a major conflict of interest problem, which is detailed quite thoroughly in the sources. Wall Street analysts, in theory, are meant to provide objective, unbiased research and recommendations on stocks. Buy, sell, hold.
Right, that's their job.
However, their firms, the big investment banks they work for, also have potentially very lucrative investment banking relationships with the very same companies the analysts are covering.
Ah, helping them issue stock, advising on mergers. Big fees involved there.
Huge fees. So there was often immense internal pressure on analysts to issue favorable ratings strong buy, for companies that were current investment banking clients or even just potential future clients. As the sources put it rather bluntly, analysts were often under pressure to lick the hands that feed them.
So the research wasn't necessarily objective.
The potential for bias was enormous, and the studies cited in the sources provide pretty stark proof of the real-world impact of this conflict.
What did they find?
During the height of the internet bubble, for instance, stocks that received strong buy recommendations from analysts whose firms also had investment banking ties to that company significantly underperformed the overall market.
Wow. So the strong buys were actually bad investments on average.
When they came from conflicted analysts, yes. On the flip side, those rare sell recommendations, which were often issued by smaller, independent research firms that didn't have those investment banking conflicts, those stocks actually outperformed the market significantly.
That's damning evidence, isn't it?
It's incredibly compelling evidence that a lot of the analyst research investors were relying on, especially during that mania period, was tainted. It actively misled people, often encouraging them to buy stocks that were already dramatically overpriced right before they crashed.
And there were other issues too, right? Like analysts leaving.
Yes. The sources mention that analysts might leave the research side for more lucrative jobs in portfolio management, actually running money. This could potentially dilute the pool of experienced, truly objective research expertise available to the average public investor. The whole system, arguably, wasn't really set up to provide unbiased fundamental truth. It was often geared more towards facilitating deals and generating banking fees.
It's just such a powerful reminder, isn't it, that even when you're trying to rely on expert fundamental analysis, you have to be incredibly careful. You need to be aware of the potential conflicts, the limitations of forecasting.
Absolutely. Take it all with a grain of salt.
And we shouldn't put blind faith in perceived investment gurus either, right? Or follow someone just because they had amazing past success, especially if the numbers they're presenting seem almost too good to be true.
That's another crucial point. The story of the Beardstown Ladies Investment Club, which is mentioned in the source material, is a perfect, if somewhat unfortunate, illustration of this.
Right. What happened with them? They were famous for a while.
They became incredibly famous. Their story of this small group of older ladies in Illinois achieving supposedly phenomenal investment returns through their simple homespun investment club captured the public imagination. They wrote best-selling books, appeared on TV.
Everyone thought they had the secret sauce.
Exactly. But then their performance was actually audited by a major accounting firm, Price Waterhouse. And the audit revealed that they had been incorrectly accounting for certain things. Crucially, they had been counting their own membership dues, the money they put into the club each month, as part of their investment profits.
Oh no, that's not how returns work.
Not at all. Once that was corrected, their actual investment returns over the period were revealed to be significantly lower than the overall market average, like the S&P 500.
So the amazing track record was basically an accounting error.
Largely, yes. It's a really powerful lesson. Always question extraordinary claims. Don't just worship investment idols based on past reported success. Dig into the numbers yourself. Understand how the returns were generated. As the sources cleverly paraphrase a biblical warning, applying it to market gurus, he who looks back at the predictions of market gurus dies of remorse. Following a guru blindly based on past glory, just like following the crowd, can lead you straight to regret.
Okay, so if following the crowd into these speculative bubbles is clearly dangerous, and if relying on potentially flawed or conflicted methods like charting or mainstream analyst reports isn't a reliable alternative either, where can investors turn? How do we find a disciplined path forward that avoids all these pitfalls?
Right. This is where we need to shift focus, moving beyond the critiques and looking towards alternative approaches. More disciplined, often evidence-based strategies that stand in direct contrast to herding behavior and speculative chasing.
What's the first one?
One fundamental philosophical approach, mentioned prominently, is contrarian investing.
Going against the grain.
Exactly. It's the direct opposite of following the herd.
So you deliberately do what everyone else isn't doing.
That's the core belief. A contrarian investor operates on the principle that herd behavior inevitably pushes asset prices to irrational extremes. It makes popular assets significantly overpriced and unpopular, neglected assets significantly underpriced.
Okay.
And this creates opportunities for investors who have the discipline, the analytical rigor, and maybe just the sheer fortitude to buy assets when everyone else is panicking and selling, and to sell assets when everyone else is euphoric and buying.
That sounds like Warren Buffett's famous advice.
It is. His timeless quote perfectly encapsulates the contrarian mindset. Be fearful when others are greedy and greedy when others are fearful.
Which, as you pointed out earlier with the Kindleberger quote, is incredibly difficult psychologically, right? When everyone around you is caught up in the excitement or the panic.
Immensely difficult. It requires tremendous discipline, independent thinking, and often a willingness to look wrong, sometimes for extended periods, before the market eventually recognizes the value you saw or corrects the excess you avoided.
You have to be comfortable being lonely.
In a sense, yes. As Darius Foros suggests in the material provided, to genuinely outperform the market consensus over the long haul, an investor almost must deviate from that consensus in some meaningful way. You simply can't achieve above-average results by doing the exact same thing everyone else is doing. Contrarianism is one powerful way to deliberately forge that independent path.
Okay, so contrarianism is a philosophy. Are there more specific, maybe systematic strategies that are rooted in academic research, offering an alternative to just owning the whole market based on size or chasing trends?
Yes, absolutely. This is where we get into the world of what's often broadly categorized now as factor investing, or sometimes called smart beta.
Factor investing, what does that mean?
These are strategies built on decades of academic research, much of it pioneered by Nobel laureates like Eugene Fama, which has identified specific, measurable characteristics or factors of stocks that have, historically at least, been associated with different patterns of risk and return compared to a simple market index like the S&P 500.
So it's about tilting your portfolio.
Exactly. They offer ways to structure portfolios with deliberate tilts away from just owning everything based purely on its market capitalization or size.
Okay, so what are some of the key factors that have shown this historical evidence? What are the big ones?
Well, probably one of the most prominent and well-researched factors is the value versus growth premium.
Value stocks versus growth stocks. What's the finding there?
Research, particularly the seminal work by Fama and French, consistently showed that over long historical periods, we're talking many decades, value stocks tended to outperform growth stocks on average.
And value stocks are?
Typically defined as companies trading at low multiples relative to their fundamental metrics, things like low price to earnings, PE ratios, low price to book value ratios, book value being the company's net asset value per share, basically. Or maybe high dividend yields. They look cheap on paper.
Okay. And growth stocks are the opposite, high multiples.
Right. Growth stocks are typically those trading at high multiples, often because investors have very high expectations for their rapid future growth in earnings or sales. They might be in exciting new industries, but they're already priced for that exciting future.
So the historical evidence suggests that buying the stocks that look cheap based on traditional fundamental metrics has generally been a better long-term strategy than chasing the most popular, fastest-growing companies that are already maybe priced for perfection.
Broadly speaking, over very long time horizons, yes, that's what the historical data tends to suggest.
Yeah.
And investors today can get exposure to this kind of factor, tilt relatively easily through specific exchange-traded funds or ETFs.
Right, those baskets of stocks.
Yeah. Our sources mention examples like Vanguard's VVIX, which focuses on large-cap value stocks, and its counterpart VIDX, which focuses on large-cap growth stocks, just to illustrate the different universes you can invest in.
So you can choose to tilt towards value.
You can. The source also makes an interesting point, though. While the value factor itself seems to have offered a premium historically, there's also a potential double bonus scenario. If you happen to buy a growth stock, but you buy it at a reasonable valuation multiple, not an insane one,
Okay.
and then its earnings really do grow strongly, and maybe the market gets even more excited and its valuation multiple expands over time, well, that combination can lead to truly amplified returns. But the core factor strategy itself is the tilt towards statistically cheaper, value-oriented stocks.
Okay, so value versus growth is one major factor. What about the size of the company? Does that matter?
It seems to have, historically. That leads us to the second well-known factor, the size premium.
Small companies versus big companies.
Exactly. Decades of historical data, including foundational work compiled by Ibbotson Associates and further explored by Fama and French, has shown that, on average, small company stocks, small caps, have generated higher average returns than large company stocks, large caps, over very long periods.
How much higher?
Well, Fama and French did studies where they divided all stocks into 10 groups, or deciles, based on their market capitalization, their size. And they consistently found that the stocks in the smallest decile, decile 1, significantly outperformed the stocks in the largest decile, decile 10, over the long run.
Is there a theoretical reason for this? Or is it just, a historical quirk, an anomaly?
The prevailing academic thinking is that it's likely compensation for risk. Smaller companies are generally considered riskier than large established ones.
How so?
Well, they might be less diversified in their business operations, maybe more vulnerable to economic downturns, perhaps less financially stable, or their stocks might be less liquid, meaning it could be harder to buy or sell large amounts of their stock quickly without significantly affecting the price.
So the higher historical return is seen as the market paying you for taking on that extra risk compared to investing in big, stable blue chip companies.
That's the general explanation, yes.
Yeah.
And again, investors can access small cap exposure, often combined with a value factor. So small cap value stocks through specific index funds or ETFs like Vanguard's VS Max mentioned in the sources.
But are there caveats here too?
Definitely. It's important to acknowledge potential issues like that liquidity risk, especially during times of market stress when everyone might rush for the exits at once, and there's always ongoing academic debate about whether the size premium will persist as strongly in the future as it seems to have in the past, especially now that's so well known.
Okay, so value and size seem to be the two big ones with long historical backing. The sources also briefly touch on momentum and low beta. Can you quickly explain those?
Sure. Momentum is based on the observation that stocks that have performed well in the recent past, say, over the last 3 to 12 months, show a tendency to continue performing well in the very short term. And conversely, recent losers tend to continue losing for a short period.
So trends tend to persist for a little while.
For a little while, yes. There's some solid academic evidence for this short-term persistence. However, the challenge with momentum strategies in practice is that they often require frequent buying and selling to keep chasing the recent winners. And those transaction costs, brokerage commissions, bid-ask spreads can significantly eat away at any potential extra return, making it hard for individual investors to profit consistently from momentum alone.
Okay, and low beta. Beta measures market sensitivity, right?
Beta measures how much a stock's price tends to move up or down relative to the overall market. A beta of 1 means it generally moves in line with the market. A beta greater than 1 suggests it's more volatile than the market, and less than 1 suggests it's less volatile.
So you'd think high beta stocks, being riskier, would offer higher returns.
That's the traditional theory from the capital asset pricing model, or CAPM. But surprisingly, historical data, including work by FOMO and French that's visualized in the source material, has shown a relatively weak or even flat relationship between a stock's beta and its long-run average return.
So simply loading up on high beta stocks hasn't historically guaranteed higher returns?
Not reliably, no.
Yeah.
Which is kind of counterintuitive. Now, beta can still be a useful tool for portfolio construction, maybe for managing specific types of risk or implementing certain strategies like leveraging a low beta portfolio. But beta itself hasn't proven to be a strong, standalone predictor of higher returns in the way that value or size historically appeared to be.
Interesting. Okay, so if value and size are the most compelling historical factors, can investors try to combine them or maybe even add others like profitability into a single strategy?
Yes, and that's exactly the idea behind what are often called blended factor strategies, frequently marketed under that smart beta umbrella term we mentioned.
Smart beta.
The goal here is to create portfolios that have deliberate tilts towards multiple factors simultaneously. So, for instance, you might overweight stocks that score well on both value metrics and small cap metrics. Or you might add screens for momentum, or for company profitability, or low investment, trying to capture several potential sources of return or risk reduction at once.
Are there specific firms known for this?
Yes. Firms like Dimensional Fund Advisors, DFA, had built their entire investment philosophy around constructing portfolios based on these academic factor principles. You also see strategies like RAFI, or fundamental indexing, which weights stocks based on fundamental measures like sales or dividends, rather than market cap, effectively creating tilts towards value and sometimes other factors.
And the hope, presumably, is that by combining these different factors, you get a benefit, either reducing overall portfolio risk because the factors don't all move perfectly together, or maybe enhancing long-term returns compared to just owning a standard market index.
That's definitely the theory, yes. Diversification across different factor exposures could potentially offer benefits if, say, value stocks are doing poorly but momentum stocks are doing well, or vice versa. If they don't all perform well or poorly at the exact same time, combining them might smooth the ride or boost returns. However, and this is important, The sources provide a pretty crucial caution regarding many smart beta strategies.
Okay, what's the key warning there? What should listeners be aware of?
The main warning is that the marketing hype surrounding smart beta can sometimes significantly outpace the actual achievable reality for investors. It can sometimes feel more like smart marketing than genuinely smart investing.
How so?
Well, for one thing, the apparent success of a factor strategy can be highly dependent on the specific market environment at the time the strategy is implemented or measured.
Timing still matters, even with factors.
It can, significantly.
Yeah.
For example, a strategy tilted heavily towards value stocks looked absolutely brilliant in the years immediately following the dot-com bubble bursting in 2000.
Right, because tech stocks crashed.
Exactly. Growth stocks, especially tech, were incredibly overpriced relative to boring old value stocks at that peak. So the value strategy wasn't necessarily inherently brilliant forever. It just happened to be tilted towards the part of the market that was cheapest and most neglected at that specific moment when the bubble popped. Its subsequent outperformance was partly just a recovery from extreme undervaluation.
So a lot of the perceived benefit might have been due to starting valuations.
That's a big part of the argument, yes. And critically, the higher returns often attributed to these factor strategies don't necessarily represent some kind of magical mispricing that's being cleverly exploited for free money. More often, those higher returns likely represent compensation for taking on added or different types of risk.
Can you give an example of that?
Sure. The source gives the example of the RAFI fundamental index strategy performing very well coming out of the 2008-2009 financial crisis. Well, part of the reason for that strong performance was that the strategy, by its nature of weighting based on fundamentals like book value, ended up being significantly overweight in big bank stocks.
Which had been absolutely hammered during the crisis.
Exactly. They were trading at extremely low fundamental valuations because the market feared many might fail entirely. So buying those stocks heavily in 2009 was essentially a bet that the banking system would recover, which thankfully it largely did.
But it was a very risky bet at the time.
Extremely risky. That outperformance wasn't just finding a free lunch due to mispricing. It was largely risk compensation for taking a significant gamble on the survival and recovery of the financial sector. Had things turned out differently, those bets could have gone very wrong.
That's a really important distinction. So while factor investing and smart beta offer a potential path away from simple market cap weighting and just chasing the latest popular trend, it's not some kind of guaranteed shortcut to riches.
Definitely not. It involves its own complexities, its own potential risks, and importantly, these strategies can and do experience long periods of underperformance relative to the broad market. You really need to understand what factors you're tilting towards, why those historical premiums might have existed, often risk, and be prepared to stick with it through thick and thin. And be particularly wary of the more complex or highly marketed strategies. Sometimes they can just be a riskier mousetrap, as one source puts it.
Okay, so given that simple herding is dangerous, relying on flawed methods like charting or conflicted experts isn't the answer, and even sophisticated factor investing requires careful understanding and managing expectations. What are the fundamental, maybe timeless principles for investing wisely? You know, the kind of bedrock principles that allow you to build wealth slowly and surely, regardless of whatever market fads are currently raging.
Right. This is where I bring it back to basics, pulling together the core principles for sensible long-term investing that emerge consistently from the source material, standing in stark contrast to all the speculative chasing we've been discussing.
What's principle number one?
Perhaps the most fundamental law of finance, maybe the only one that's truly inviolable. Risk and reward are related. You simply cannot expect to achieve higher potential investment returns without accepting greater uncertainty, greater volatility, greater risk.
No free lunch.
Exactly. The historical data from Ibbotson Associates, which is presented conceptually in the sources, makes this trade-off crystal clear. Looking back over many decades, small company stocks offered the highest average annual returns, but they also exhibited, by far, the highest year-to-year volatility and the biggest potential drawdowns or losses.
And at the other end?
U.S. Treasury bills offered the lowest average returns, but they were also the least volatile and the safest investment, with essentially zero risk of losing principal if held to maturity. Large stocks, corporate bonds, government bonds, they all fall somewhere along that spectrum of risk and expected return.
So if someone promises you high returns with low or no risk?
Run away. It's almost certainly either a scam or the risk is hidden somewhere. You can't easily see it. As one of the sources puts it quite pointedly, you can only get poor quickly. To get rich, you will have to do it slowly. Building durable wealth is a marathon, not a sprint fueled by highly speculative bets.
Okay, risk and reward are related. What's principle number 2?
Diversification is key. This is probably the closest thing we have to a free lunch in investing, although its main benefit is managing risk, not necessarily boosting returns directly.
Don't put all your eggs in one basket.
That's the essence of it. By combining different types of assets, different asset classes that don't always move perfectly in sync with each other, you can reduce the overall volatility and risk of your total portfolio compared to holding just one or two types of assets.
The sources use an island economy analogy.
Yes, the classic example. Imagine an island economy with only two businesses: an umbrella factory, which does great when it rains, and a beach resort, which does great when it's sunny. Investing solely in either one would give you a very bumpy ride.
Right. Feast or famine, depending on the weather.
Exactly. But if you combine them, owning shares in both, your overall income stream becomes much steadier, much less volatile, because their risks are somewhat negatively correlated. One tends to do well when the other does poorly. That's the power of diversification.
And we need broad diversification, not just across different stocks.
Absolutely. Broad diversification is crucial. That means not just across many different individual stocks within one market, but across different asset classes like stocks, bonds, real estate, perhaps access through real estate investment trusts or REITs, maybe even commodities.
And geographically, too.
Yes, very important. Investing globally across the U.S. market, other developed foreign markets like Europe, Japan, Canada, and also emerging markets like China, India, Brazil is crucial for diversification. While it's true that correlations between different global stock markets have generally risen over time, as some charts in the sources might show, meaning they move together more than they used to.
They still don't move in lockstep.
Far from it. Holding international stocks can still significantly reduce your overall portfolio volatility. It also exposes you to potentially different growth opportunities happening outside your home country. For example, during the 2000s, often called the lost decade for U.S. stocks, emerging market stocks delivered spectacular returns. If you only owned U.S. stocks, then you missed out entirely.
So, rule 2, diversify broadly across asset classes and geographies. Don't put all your eggs in one basket, whether that basket is a single stock, a single industry, a single asset class, or even just a single country. What's next?
Principle number 3, save consistently and early. This isn't really about clever investment strategy. It's about behavior and discipline. It's about harnessing the incredible power of compound growth over long periods of time.
Compound growth. Albert Einstein supposedly called it the 8th wonder of the world.
Or the greatest mathematical discovery, yes. Whether he actually said it or not, the concept is incredibly powerful. And it's easy to see why when you look at the numbers.
Give us an example.
Well, the classic historical example used is the supposed $24 purchase price of Manhattan Island back in 1626. If that $24 had been invested immediately at a modest, say, 6% annual rate of return, if I compounded over the nearly 400 years since then, it wouldn't be worth just a few $1,000s today. It would have grown to well over $100 billion, vastly exceeding the current estimated value of all Manhattan real estate.
Wow. That's astonishing, just from $24 growing over time.
It demonstrates the exponential power of time and consistent growth. The table included in the sources, showing how much consistent monthly savings can accumulate over decades, also dramatically illustrates the point. Starting early, even with relatively small amounts saved consistently, allows compound growth to work its magic and build significant wealth over a lifetime.
So the key is consistency, and maybe more importantly, starting now. Time is your greatest asset.
Absolutely. Time in the market is far more important than trying to time the market. And for those listeners who might be later in life and haven't started saving seriously yet, the sources emphasize the harsh reality. You will likely need to implement a rigorous, significant savings plan going forward, and potentially even consider delaying retirement plans to build a sufficient nest egg in a shorter time frame. It's just math.
Okay, principle 4, utilize tax-advantaged plans. This sounds important, but maybe less glamorous.
Less glamorous perhaps, but hugely impactful. These are described in the sources, quite rightly, as truly good deals offered by the government, and investors should take full advantage of them. We're talking about accounts like individual retirement arrangements, IRAs, workplace retirement plans like 401k or 403bs, and 529 plans for education saving.
What makes them such a good deal?
They offer significant tax benefits that can dramatically boost your final investment value compared to just saving and investing in a standard taxable brokerage account.
How so? What are the benefits?
Well, Depending on the specific type of plan, you might get an upfront tax deduction for your contributions, like with a traditional IRA or 401k, which reduces your taxable income today. Then, crucially, your investments inside the plan typically grow tax-deferred or even tax-free year after year. You're not paying taxes on dividends or capital gains each year as they accrue.
Which lets the compounding work even faster.
Exactly. And then, depending on the plan, your distributions in retirement might be taxed, traditional, or completely tax-free, Roth IRAs, 401k, or tax-free if used for qualified education expenses, 529s. The comparison table included in the source material, showing the difference in long-term accumulation between saving in a taxable account versus an IRA, makes it very clear. The ongoing tax drag from dividends and capital gains in a taxable account significantly reduces your final nest egg.
So the advice is to maximize contributions to these tax-advantaged accounts whenever possible.
Absolutely. It's one of the most straightforward and impactful steps you can take to boost your long-term wealth accumulation. It's basically free money from the government in the form of tax savings.
Okay, principle 5. Recognize your risk tolerance. This sounds more subjective.
It is. While objective financial planning can help determine your capacity to take investment risk based on your age, income, expenses, time horizon until you need the money, other assets.
Right. Can you financially afford the potential losses?
Exactly. But asset allocation, deciding how to split your investments between potentially higher growth but riskier assets like stocks and lower growth but safer assets like bonds, is also deeply personal. It's an art based on your subjective comfort level with volatility.
The sleep at night test.
That's a great way to put it. Can you actually sleep at night when the stock market inevitably goes through one of its periodic downturns? If watching your portfolio value drop by, say, 20% or 30% causes you immense stress, anxiety, and makes you want to panic and sell everything at the bottom, then you likely need a less aggressive asset allocation, meaning a lower percentage in stocks than someone who views such drops as potential buying opportunities, or can simply stomach the volatility without losing sleep.
So you need to find a balance.
Yes, a balance between your objective financial capacity for risk and your subjective emotional tolerance for market fluctuations. If you know that big market drops will trigger panic selling for you, it's far better to adopt a more conservative portfolio allocation that you can actually stick with through thick and thin, rather than aiming for the highest possible returns with a super aggressive portfolio that you end up abandoning at the worst possible moment during a crash. Sticking to the plan is paramount.
Okay, that makes sense. Principle number 6. The sources mention dollar cost averaging and rebalancing as useful disciplines. What are these?
They're practical techniques for managing risk and instilling discipline. Dollar cost averaging simply means investing a fixed amount of money at regular intervals, say $500 every month, into a mutual fund or ETF, regardless of whether the market is up or down.
So you're not trying to guess the best time to invest.
Exactly. It takes market timing completely out of the equation. It avoids the risk of investing a large lump sum right before a major market crash. And mathematically means you automatically buy more shares when prices are low and fewer shares when prices are high, which can potentially lower your average cost per share over time. Many people do this automatically through their 401k contributions every paycheck.
Okay, and rebalancing. What's that?
Rebalancing involves periodically adjusting your portfolio back to its original target asset allocation. For example, let's say your target is 60% stocks and 40% bonds.
Yeah.
If stocks have had a great run and now make up 70% of your portfolio value, while bonds are only 30%, rebalancing would mean selling some of those appreciated stocks, taking some profits, and using the proceeds to buy more bonds, bringing your allocation back to the desired 60-40 split.
So it forces you to sell high and buy low, in a way?
In a disciplined, systematic way, yes. Rebalancing is inherently countercyclical. It forces you to trim back the assets that have performed well recently, often the ones the herd is currently chasing, and add to the assets that have lagged, often the ones the herd has abandoned or dislikes. The rebalancing chart, often shown in sources, illustrates how this discipline can potentially enhance long-term returns slightly compared to never rebalancing. But its main benefit is definitively keeping your portfolio's risk level consistent with your target, preventing it from drifting too far into risky territory after a long bull market, for example.
Got it. Okay, principle number 7, control costs. This sounds straightforward, but maybe easily overlooked.
Hugely important, and yes, often overlooked or underestimated by investors. High costs are like a relentless drag on your investment returns, eating away at your wealth year after year. We're talking about management fees charged by mutual funds or investment advisors, trading costs from frequent buying and selling, often referred to as high portfolio turnover, All of these significantly depress your net take-home returns over time.
And active managers tend to have higher costs.
Generally, yes. The sources, particularly when comparing actively managed funds, where a manager is actively trying to pick winning stocks or time the market, to passively managed index funds, really highlight this cost difference. Actively managed funds typically charge higher annual expense ratios, management fees, and often have higher internal trading costs because they're buying and selling more frequently.
Whereas index funds just try to track an index.
Right. Index funds, which simply aim to replicate the performance of a broad market index like the S&P 500 by holding all the stocks in that index in proportion to their market size, are incredibly inexpensive these days. Many broad market index funds, or ETFs, have annual expense ratios that are very close to zero, just a few hundredths of a percent.
So investing via low-cost index funds is a great way to get broad diversification very, very cheaply.
It's one of the most effective strategies for the vast majority of investors, yes. Minimize costs, maximize diversification, and if you do decide you need or want help from an investment advisor, the sources strongly advocate for choosing fee-only advisors.
Fee-only why?
Fee-only advisors charge you a transparent fee directly for their advice or management, maybe an hourly rate, a flat fee, or a percentage of the assets they manage for you. They don't earn commissions by selling you specific investment products like high-fee mutual funds or annuities. This significantly reduces potential conflicts of interest, making it more likely their advice is aligned with your best interests.
That makes sense. And automated services.
Automated investment services, often called robo-advisors, are also mentioned as a potentially lower-cost option for getting basic portfolio management and advice, especially for smaller accounts. They typically use algorithms to build and manage diversified portfolios of low-cost ETFs based on your goals and risk tolerance.
Okay. And finally, one more point mentioned, though maybe not for everyone, considering annuities.
Yes, the sources touch on annuities, primarily as a tool to manage longevity risk in retirement. That's the risk of outliving your savings.
How do they work?
Essentially, an annuity involves giving an insurance company a lump sum of money, or sometimes periodic payments, in exchange for a guaranteed stream of income for a set period, or often for the rest of your life no matter how long you live.
So it's like buying a personal pension.
That's a good way to think about it. Now, annuities can be very complex, and many types, particularly variable annuities or equity-indexed annuities, come with notoriously high fees and surrender charges, so you have to be extremely careful.
But simpler, low-cost options exist.
Yes, relatively straightforward. Low-cost, fixed immediate annuities are available. And for some individuals, especially those without traditional pensions who are very concerned about running out of money late in life, using a portion of their retirement savings to purchase an annuity, maybe enough to cover essential living expenses, can make a lot of sense as part of a broader retirement income plan. It's about securing a baseline level of lifetime income. Tax considerations are also important when thinking about annuities.
Okay, so those are the core principles. And underpinning all of them really is the big lesson we learned from all those historical bubbles. Avoid the speculative pitfalls.
Absolutely. It circles right back to the beginning. Stay away from things that have obvious warning signs or are fueled purely by excessive hype and speculation rather than underlying value.
Like what specifically?
Well, things like new issues or IPOs, initial public offerings. Historically, the average IPO tends to underperform the market after its first day pop, partly because they're often priced to maximize proceeds for the selling company and its investment bankers, not necessarily to be a good deal for initial public buyers. Be wary of assets whose value seems driven entirely by narrative and momentum with little fundamental support, like that highly speculative stock offering warned about in one of the sources.
And don't rely on potentially conflicted advice.
Exactly. As we discussed, be extremely cautious about relying solely on analysts or advisors who might have clear conflicts of interest. Basically, don't get lured into chasing those glittering but ultimately empty speculative castles in the air.
So let's try to bring it all together then, from this whole deep dive into the sources. What's the main takeaway?
I think the pattern that emerges is just undeniable, isn't it? Herding behavior, fueled by these really potent psychological forces, FOMO, social proof, cognitive biases like recency and representativeness, has repeatedly throughout centuries of history led investors into dangerous speculative bubbles and resulted in devastating losses. From tulip mania to the South Sea bubble to the Nifty 50, the dot-com bust, the housing crisis, even cryptomanias. The pattern repeats.
And relying on the conventional alternatives like trying to read chart patterns or trusting mainstream expert analysis, that hasn't reliably protected people either.
No. Charting seems to be based on finding patterns in randomness, and expert analysis can be riddled with forecasting errors and significant conflicts of interest. They haven't proven to be reliable shields against the madness of crowds.
So the sensible, sustainable path forward, the way to actually build durable wealth over the long term. It isn't about trying to predict the market's next big move, is it? It's not about perfectly timing the peaks and troughs or jumping onto whatever asset the crowd is currently piling into this month.
No, it really isn't. It's about embracing disciplined, evidence-based strategies. It's about understanding the fundamental relationship between risk and reward. It's about controlling risk through broad diversification across different asset classes and geographies. It's about the discipline of saving consistently over the long term, letting compounding work for you.
And it's about minimizing the things you can control, like the corrosive impact of high fees and unnecessary taxes, by using low-cost investments and taking full advantage of tax-advantaged accounts like IRAs and 401ks.
Exactly. It's also about honestly assessing your own tolerance for risk and setting an appropriate asset allocation you can stick with, and maintaining a long-term perspective that's grounded in fundamental financial principles and your own goals, rather than getting swept away by the short-term noise and the infectious madness of others, chasing those speculative castles built on nothing but thin air.
And that contrarian mindset we talked about. Maybe at its core, it isn't even really about trying to be smarter or timing things better than everyone else. Maybe it's just about having the discipline to avoid making the big, emotional, herd-driven mistakes that repeatedly lead the majority astray over time.
That's a fantastic way to frame it. Avoiding the big mistakes is often more important than hitting home runs. So perhaps the final thought for you, the listener, to ponder is this. Given just how powerful that urge to follow the crowd can be, especially when you see friends or neighbors seemingly winning big, and you feel that intense fear of being left behind, what personal filters, what rules, or maybe what external structures, like a written investment plan or working with a trusted objective advisor, what do you need to put in place right now to ensure that your future financial decisions are informed, logical, based on evidence, and your long-term principles, rather than just getting swept up in the inevitable next market mania?
That is definitely something to truly ponder as you navigate your own investment journey. And that's it for this deep dive.
We really hope these insights drawn from all these historical sources and research have been valuable for you.
And maybe provide a clearer, more disciplined path forward. We'll see you next time.